Good afternoon. Happy Thursday. We have a ton to cover here this week with inflation, jobs, the Fed, and a really good question from Jody about consumer spending kind of continuing to grow even in the light of all the challenges and headwinds in the economy. So my name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. So before we get into maybe the core of today around the Fed, which of course is going to be one of the biggest stories, I do want to set the stage here a little bit and talk about inflation and jobs. So looking into last Friday, we had PCE data come out, which is inflation measurement. And basically, the inflation numbers came out pretty much in line with expectations, still showing year-over-year inflation at 3.4 and 3.7% for the core. But, I think it's important to note that the PCE, excluding food and energy, so the core PCE, did jump pretty significantly this past month. Now, numbers are falling off on the back end and being added on the front end. So again, year over year, it means the number was the same, but it is important to note that this last month, the PCE, the core PCE data number did jump pretty significantly. All right, so inflation is, let's say, in line with expectations, but still running much higher than 2%. On top of that, we had ADP employment report yesterday, and we have non-farm payrolls tomorrow, okay? So the jobs number tomorrow is going to be really important. ADP employment, report, again, take it with a bit of a grain of salt. It did show we added a lower number of jobs, but the number tomorrow is really much more important. But even with inflation still persistent and this jobs data really in focus this week, the Fed's, the main story was kind of surprisingly not addressing either of these. Obviously they did talk about inflation, don't get me wrong, but they hardly even discussed the importance of the labor market in the conversation yesterday. And as you probably know, especially if you tune into these each week, that is always a constant focal point for the Fed's press conference afterwards to talk about the strong labor market and how important that is. And, that's why they feel like they can continue hiking. This month's update was very little, if any, directly addressing the labor market. So let's talk a little bit about the Fed. Hopefully that sets the stage. Again, jobs basically still being strong. We'll see this week, but a big week this week in jobs data, and inflation staying persistent so far anyways. All right. So the Fed decision was yesterday and the press conference to follow. The long and short of it, if you just want the bullet points, is that they decided not to hike this meeting. I will share that is not a surprise at all. I think hardly anybody was expecting the Fed to actually hike in this particular meeting. But I think what was a surprise, or at least from my perspective, was the tone in all of this press conference to follow. To really simplify things, up until this point, the tone of the Fed, the general message of the Fed, has always been that they will keep hiking until the data suggests otherwise. My takeaway from the press conference yesterday was that this completely reversed. And what I got out of it was that this week's message was that the Fed is done hiking unless the data tells them otherwise. So a huge shift in the message that they're trying to get out there, I think, and the message or the tone of how they're approaching things moving forward. To maybe dig into the weeds a little bit, they kept highlighting that financial conditions have tightened, which certainly seems to be the case. Obviously we've seen it in the markets. The markets have reflected that. A lot of analysts are now coming out with some concerns, and so they kept pointing to this. They did say that they are not confident that they've achieved this substantially restrictive policy to get inflation to 2%, but they did really highlight that tighter conditions and trends are kind of suggesting that they're working towards this. One thing that they did point out that I think is really important is that they said they are not even thinking about cutting rates. So looking into next year, this conversation about higher for longer, it was very clear again in this press conference that they are not anywhere near talking about cutting. All right, if I'm to summarize all of this conversation, I think the biggest takeaway that I got out of this, or summary takeaway, is that the Fed is maybe another hike is not nearly as clear as it was after last meeting. I think the tone definitely flipped, and it seems like the data is going to need to prove that we need another hike as opposed to the other way around. The second takeaway is that it is very likely we're going to see rates higher for longer. I think that this is important because I do believe that inflation is a bit sticky, but basically the next hike, not as clear as it was going into this meeting, and rates are likely to stay higher for longer. So what does all this mean? Well, first, I think that it seems that we are back to where we were through all of 2023, where, earlier in the year, you may remember the market really took these press conference as the Fed is done. They kept calling the bluff, even though the Fed was direct, the market was calling their bluff, and we kept seeing the market react to the Fed press conference as if things were good and we were moving on, even though the Fed kept saying otherwise. This time, the Fed is kind of saying otherwise. And so I think that we're going to be back to that type of environment where the markets are going to react to every data point. And if they are in line or somewhat better, we could see the market really believe that the Fed is done. And we could find out, who knows, that it might be the opposite when the time does come for that December meeting. More importantly, I think the question is this a mistake? And what I will say from my perspective is I have to admit, I truly hope they haven't thrown in the towel. I hope they continue to be objective, although that's maybe not entirely true from the past as well. But I hope that they are objective and they review the data, because it seems like there are a lot of subjective factors going into this. My biggest concern, why I'm worried that this could be a mistake, is that I still believe that inflation is sticky. It's showing, and it continues to show much stickier than anybody had talked about. So I still believe that inflation is sticky. And if they stop early, and again, this is mostly because they started too late, to be clear, but if they stop early and inflation is stickier than they are maybe expecting, it could open up the door to this idea of stagflation. So for those who were, following the markets in the 70s, you know exactly what I'm talking about. But this is a big concern. Now, it doesn't mean this is going to happen, to be very clear, but I do worry that if they throw in the towel and they call it quits too early, they could open the door for that type of scenario. So I truly hope they don't misstep here. It may be better to have a shorter term pain than deal with a longer term pain of stagflation, I guess is what I'm trying to say. So hopefully they will be thoughtful in their meetings coming up and really review the data thoroughly without any subjective kind of take on how that looks. All right. That's a lot, but obviously a lot to cover this week. And I do want to briefly touch on a great question from Jody. The question from Jody is about this recent GDP report from last week. So a good follow-up. And basically the question is why is discretionary spending up, even though there's a lot of uncertainty, a lot of people are not feeling confident, yet us as consumers continue to spend? So there's, I think, a few factors in this. One of them is to be aware that inflation can impact these numbers, right? So if we adjust the spending for inflation, that's really the number you want to focus on. Know that some data measurements may include inflation in the number you're reviewing. And so spending may look up much more than it is just because prices are higher, right? The other thing I want to touch on here is the continued excess money supply. So back in 2020, money supply went through the roof. And there is a bit of a lagging effect to that, right? All that money gets injected in the system. It takes a while for it to be fully circulated. And so that certainly has an impact as well. On top of that, there's an unbalance in the labor market, right? So a lot of job openings and, unemployment being low, all this often leads to spending. Unfortunately, it is all too often that spending doesn't stop until jobs are officially lost, regardless of how concerned people are in the market. So hopefully we don't necessarily see that, but that is the reality. And I think that has a factor in this. And then last would be pent-up demand. After COVID, what I will share is that I'm sure many feel the same as well. But there was a lot more spending, a lot more people going on trips and things like that to make up for some lost time. So I think those are kind of the four factors. I think that people should maybe be a little more cautious in their spending at this point. But nonetheless, I think this is why we're seeing continued consumer strength, and we'll see if that continues into the holiday season. So thanks, Jody, for sending that in. Thank you all for joining us this Thursday. We've certainly seen a reaction in the markets here the last 2 days after the Fed press conference. So hopefully that was helpful to debrief a bit, and we'll see you next Thursday at 3.